And joining me on the podcast right now and in video, why I'm smiling, a podcast that needs smiles, Paul Hill, full-time investor, equity analyst as well. And Paul, we've got lots of company news out there, but just quick top line on macro a little bit. I've seen this bandied about a little bit here. We talked about peak inflation. When the market sees that, of course, it'll take a lot longer to translate into real prices in the shops and stuff. But when the market sees peak inflation, we're thinking it could get a bit better in the markets. Now I'm seeing peak hawkishness happening, and the Fed may be rolling back on their interest rates hikes. Explain that. Explain the difference there. What's going on here? Why the Fed? Why are people now thinking the Fed's going to roll back on the interest rate hikes?
Well, basically, you've got the US yield curve, which has definitely just come down by roughly around about 40, 50 basis points over the last 2 or 3 months. So I think the 10 years at about 3%. It had been at 3.4%. What's happening is that people are obviously getting a bit spooked in terms of the persistence of inflation, and therefore they're realizing that actually this is going to cause a major demand destruction. What you've got is basically 3 things which is driving inflation, and this is what you've got: Ukraine-Russia war, which is pushing up energy and food prices. Okay, now, if we get a rollover of that or resolution, then clearly that will be a huge benefit for CPI inflation. Okay, that's be great, but we can't see that happening in the short term. The other one we've got is for the zero tolerance policy out in China to basically for them to change that and to tweak their existing Chinese vaccines such that they can actually cope with Omicron. And if you do that, that'll free up some of the supply chain sort of disruption we've had, and therefore bring down inflation. But if we don't get a resolution to that, there's only another one, which is basically demand destruction, and that's what's happening. And you're seeing that in certain areas, like obviously the consumer side, and that's the main reason why the yield curve is currently decreasing, because basically people think we're going to get stagflation. But I mean, and that's boosted obviously the tech side. I wouldn't say with sort of it's peak hawkishness. I'd actually say the big central issue, which is investors are struggling towards, is how much it's all this is when you put it all together. How much is it going to impact earnings per share going forward in 2023? And I've worked this one out in terms of what the market is currently doing, and at round about current levels, I reckon. Because the S&P 500 earnings per share forecast for all the bottom up analysts is roughly around about $250 per share. I reckon it will be somewhere between 230 to 240 for next year, which is what's baked into the sort of, like, if you look at it as a 16 or 17 times PE multiple on the S&P 500. So they're all, even though the analysts are saying it's going to be $250 per share, the market's already saying, you're nuts, boys, it's coming down, and it's going to get to between 230 to 240. That's going to be a mild recession, i.e. not a severe recession. And it really comes down to that is how much corporate profits are going to be impacted for next year in terms of when you put all this macro. But I still see there's more upside. If you get a resolution somewhere, ceasefire or whatever it is in Russia, then that's going to be a huge benefit, a bit like the vaccine impact we had in November 2020. And if you get China basically successfully managing to develop vaccine and getting into people's arms, locally manufactured vaccine that handles Omicron or uses the US, it probably won't do the latter, but it should be able to do the former at some point. Then that will leave out the supply chains. 2 big bonuses. And, other than that, obviously we've got demand destruction, which is a bit of a nightmare. And personally, I don't think we're going to get a severe recession, but it is possible. No, nobody knows.
Mm-hmm. Yeah. Well, it's this peak inflation thing is. I mean, if you look at commodities alone, they made a big move in the last few weeks. And I was looking through some of the stats here. Natural gas down 41%, copper down 32%, wheat down 37%. You've got iron ore down 30%, corn down 20%, crude palm oil down 45%. Even Brent crude, which has been very sticky, has now down 17% from its high. So those commodities are rolling over on a little bit. So that's eased the pressure there. But of course, people are worrying about the growth going forward. In fact, why is growth stocks have had a bit of a rally over the last few days? People starting
that's because the yield curve, as I said, that's because the yield curve's decreased. So effectively, long duration assets, when you work out the DCF on it, have a higher value and therefore it's a short-term bounce in my view. But we'll wait and see. I mean, it's going to come down to a stock pickers market. There's lots of stocks out there that people go to. So if coming back, what is the central point for investors to have a look at? It's get your head around what the current macro conditions are going to do to earnings for next year, what it's going to do. And the S&P 500 is currently baking on, I think it's around about, is it 220, 230 for this year, dollars per share, rising to 250. 250 is too high. We all know that. It just depends on how much it's going to come down and whether we're going to get an earnings recession, i.e. negative on this year for next year, that goes into the severe recession camp, or alternatively, we're going to get a mild recession and just get small sort of like, level of growth, which is what the market's currently pricing in. If it's worse than that, then obviously, we're going to see some more damage and some more volatility. But it doesn't mean there aren't stocks out there that look really, a lot of it's already been baked into certain stocks. And I think there's a lot of bad news already factored in.
Yeah. And essentially, it is looking for those stocks. Like I said, if we are going to a low growth economy, you can look for, those companies that are, are growing, but are sort of almost not affected by macro issues, in sort of, recurring revenues, long contracts, hot trends, stuff like that, isn't it? And I saw a guy actually mention it. I think he's looking at 230 on earnings S&P on CNBC yesterday, and people saying that's ultra bullish. Some people don't see you get above 200. So I don't know what's going on with that. But again, down to let's talk about stocks because there's lots of news out. Like I said, you need stocks that outperform the market, not be the market. Essentially, that's what we're looking for, isn't it?
Yeah, exactly. I mean, there's one this morning which is Oncimmune, etc., which does effectively. It's got two divisions. It's got a product division which has got its early CDT test, which does the early diagnosis of lung cancer. And then it's also got a services business, which is Immuno Insights, which helps our effectively pharmaceuticals, biotech companies to improve the efficacy of their drugs in terms of sort of performance. And it basically allows you to see how your drug is going to be impacted or affected by a person's immune system, which comes down to whole personal medicine, which has been the main drive. That has been the main driver of it. But anyway, so it came out with an update today. It was a sort of a mixed bag. The products division has actually had some very good news. Its big distributor out in the US, Biodesix, has had Medicare cover approval, which means that it's going to get a lot more distribution out in the States. And even more importantly, the price point is 10 times higher than it currently is. So that is a huge endorsement of the quality of the actual test that Biodesix, its partner, has taken from Oncimmune. And so what we should see there is higher sales of the actual test from Oncimmune to Biodesix, but also going forward higher royalties. How that rolls through for next year, I don't know. Their year end used to be May at the end of each year, and they're now they've changed it to August. So they're going to do a second interim set of unaudited results in the next 2 or 3 months. But anyway, the next 12 months, we'll see how that actually rolls out in the States. That's the positive. That's one of the positives. Another positive is that, as I've always said to you, for these type of early stage healthcare, med tech type of businesses, you've got to go with the best in class technology. And one way of actually measuring that is to see the quality of the management team and who's brought in. And I've always said that, I've heard on many corners of the life sciences world that their CEO, Avingtrans AVG, is excellent and well respected. Well, they've also now attracted a really top-notch chairman as well. So that really rubber stamps the quality of the technology, which is the other positive. On the negative side, it looks as though the volatility of the markets has impacted some of the early stage biotech companies, probably out in the States, in terms of just drawing out their decision making, just prolonging some of their sales cycles, and therefore it looks as though, I mean, they don't quantify it at all. It looks as though that's negatively impacted their second half on the Immuno Insights business. So that means that, yes, for this 15-month period up to the end of May, they may have overall sort of like dropped on certain expectations. I don't know. I've not seen what the brokers have said, so I could be wrong on that. But it doesn't mean that it's changed the outlook at all. There's certainly not the long-term outlook, which is positive, and there's plenty of upside because the quality of the actual science is excellent. But I don't know what it means also in terms of blowing through into next year's earnings estimates. So I'd have to wait until their house broker Singers comes out, and haven't actually spoken to either Adam Hill or the company in terms of what that means on a financial basis. So it's not a surprise, because early stage biotech companies in this level of volatility are probably sort of like just taking a bit more cautious view rather than sort of like going putting all their eggs into lots of different baskets.
Yeah, and surely a lot of this bad news, if there is bad news, is priced in. Like this was hit 260 in April last year. It's now 75 pence.
Yeah,
so,
no, exactly.
Hammering,
But I mean, you look at the whole of the cross of the biotech sector. We've talked about it before. Look at Verice's shares. It's nuts. They've had some really good news in terms of all of their their diagnostics, and lots and lots of different companies. I mean, I spoke to Christopher Mills at Harwood Capital, who's probably one of the best sort of like investors in all things life sciences, and he's a big investor in EKF Diagnostics, which hit a price of 95p last year and is now to 32, 33. So there's absolutely plenty of bargains out there. And you just got to, as I've always said, if you're in technology or in healthcare or medicine or whatever it is, if you go with best in class technology, and Oncimmune has it with that Immuno Insights, and it looks as increasingly with their early stage lung cancer test as well, then you're going to do well, because if they're not big enough and strong enough to actually optimize or properly maximize that commercial opportunity, somebody will buy it out off them and do it for them, because the value and the gross margins on these things are great. I mean, on the Immuno Insights platform, it's well above 80%.
Yeah. A lot of people have been caught up in this. I said even some of the best investors have been caught up in this bear market, haven't they? I mean, so. It's a big drop, EKF, isn't it? Again, like you said,
yeah, wow. Well, it's an excellent quality company. I mean, it's absolutely top-notch life science business. So, but there's plenty out there, and that's what you got to sort of choose. And it's those classic babies in the bathwater. I mean, another one which has got sort of a healthcare angle to it, but is more nuclear, is in the energy transition, is Avingtrans, which came out with a inline trading update yesterday, saying that it's still seeing good, strong order books and a pipeline, and was it did a year-end trading update, was in line, and has had a good start. He expects to have a good start to the actual year. It's got plenty of cash, sort of 50p per share of cash. It's also got some spare land that it may well sell, which is another sort of like, I reckon it's probably around about another sort of like perhaps 20p, something like that, of cash per share that may well come out. And when you deduct that from the actual current shares, you get to an average PE of roughly around about sort of 15, 16 times going forward. And that's also absorbing some of the losses from the healthcare business, which is the Magnetica, and also they've invested in this new Adaptix technology, which seems to be going from strength to strength. And these are small form. The Magnetica is a small form MRI scanner, and the Adaptix one is a sort of like a equivalent, but in X-rays, and that's further up the commercialization chain. That's actually now just filed its FDA approval, so that's really going well. And there's obviously that's a loss. Those are both loss-making sort of activities at the moment, but they've got huge addressable markets that could put in pounds onto the actual share price that are not reflected into it. And if you just run the sum of the parts on all this, then I get to £5.60 out of the shares, and they're roughly around about £4.30, I think it's £4.40. They've got really long order books, niche products in, supplying these safety critical and sort of like, for harsh environments, sort of, blast proof doors. You've got the nuclear storage boxes out of Sellafield, and about over 40% of the whole order book is justified really by nuclear. And we know how much that has been rejuvenated from the Ukraine-Russia war just recently, both on sort of life extensions, new nuclear, but also, there's actually literally over 100 years just in the UK of decommissioning work in terms of things like on Sellafield, etc. So, they've got a really good visibility of high margin work, and they've got plenty of cash to look for opportunities to deploy their, so on the M&A strategy, their PI strategy, which is the pinpoint, invest and exit strategy, which has done really well for themselves. So they are a best-in-class winner that has increased its share price consistently sort of 20% over the last 13 years. And, those are just stick with your winners as much as anything.
Yeah, well, I'm sure shareholders of that are quite pleased they're holding that, because that is counter trend to AIM completely, because AIM has been down 35% since late summer last year, and that's up nearly 100%. So if you got one of those, hold on to it. In fact, bringing that onto one of your outstanders. Come on, let's talk about it. I know you're dying to talk about equals because it's done very well, and that's performed. In fact, they come out with another update today this week, and. It's strength to strength, isn't it? Going from strength to strength.
Yeah, I mean, they came out with a first half trading update with sales up over 80%. I interviewed the CEO, Ian Strafford Taylor, and he's very confident going forward. That I upgraded my numbers, and I have a sort of like a fair value of just over 150p per share, and I think they'd be well above £1 if it hadn't been for sort of institutional selling who've got to sell. We've had one of the larger shareholders who have Crystal Amber, who publicly disclosed last week that they were going to be paying a dividend, and I suspect they've been sort of selling shares just recently to fund that. And if that hadn't been happening, these shares would be well above £1. Their house broker, Canaccord, have got a target price. I think it's 149 as well. So, we're all moving in the right direction. The business is flying, good operational gearing, and best-in-class technology with, they basically do international payments and, sort of anything to do with sort of like, as a fintech platform. So, the new customers are coming in, big and small. Their solutions business is doing really well, and they're sort of the whole across of the business is doing well. And plus, they're also starting to see resurgence now of their consumer side in terms of overseas travel as well, which is really just a small part of it, but it just adds a bit of extra as well. So yeah, I mean, it's all systems go. Direction of travel is up, and I've said to this over the last 2 years, even though it's done well, I could see it going from, is it about 90? I haven't seen it today, but I guess it's about sort of high 80s, 90p, etc.
It's 89.8.
Yeah, well, there you go.
JP Morgan's come on board as well.
Yeah, JP Morgan came on board. Yeah, bought 5%. I don't know who they bought them from, but as I say, if I was a betting man, I would say it probably came from Crystal Amber, but could be anybody. Yeah. From current levels, let's say 90p is a round number. You could easily see in the next 12 months, it's sort of 130, 140 without any problem, because it's still cheap. It's still cheap on a sort of like a 2x sales multiple and growing at ridiculously fast rates at the moment. And I think you'll really see it energize sort of, in 12 months time, when you really see because at the moment they are investing heavily into the business in terms of the sales and marketing and new products, etc., which they're doing. So, but they've got plenty of cash. They don't need, it's all organic. It's all organically funded, the growth. So yeah, no, I mean it's really good. I mean, I'm absolutely delighted. But I've been banging the table about it, and I'd say the same. You know, it's probably this and Crestchick are probably they've done well for me over the last 2 or 3 years, and I would actually say they've got, you know, the next 12 months, next 2 or 3 years, they've probably got the biggest runways ahead of it as well. So there's no reason to sell them.
It's good to have companies like that. Almost in these markets, there are portfolio saviors, aren't they? You know, they hold up your value there, and while other stocks, you know, take a hit in the bear market, those kind of stocks that keep going up save your portfolio a little bit, don't they?
Yeah, I think the key there's that. I mean, I don't want to get too overexposed on it, and you never fall in love with a particular stock. But I would say when they've done well, but they're still significantly undervalued, then unless you have to sell for certain reasons, i.e. top slicing, portfolio rebalancing, or just need the cash for other things, then, you know, I'm prepared to take the risk of that bigger position and hold it, because, you know, I still think there's significant upside for it, and the management team is doing a great job, and they've clearly got something that's winning significant market share.
Yeah.
And you know, why bet against them? I mean, you're nuts to.
No, exactly. So what? How big? What percentage of your sort of stock portfolio do you take up at the moment?
Well, I haven't looked at it just over the last sort of like kind of couple of weeks, but I think, if I remember rightly, I think it's about 25%. So it's a big chunk. I'll just give you an update now. What is it?
So if you, while you're looking there,
wow, it's more than that, actually. It's more than that now. It's bloody hell. Okay, so sorry, my English. It's 27% now.
Okay. And so would you just, regardless of operations, like you said there, you know, it can be a portfolio transformational stock if you hold on to it, because the bigger it gets, of course, the more it moves, but of course, downside as well. So if operations are still good, the valuation is, in your mind, you know, still nowhere near fair value, would you still hold on regardless of what size it takes up? Or would you, at a certain level, say 30%, you start top slicing? What would you do there?
I don't have hard and fast rules. It's where you stop being able to sleep at night. Or all I would say is that, you know, if this stock went to zero, yeah, it would cost me, as you know, a lot of money. I mean, I'm, you know, really quite a significant 7-figure number. Okay. But I wouldn't, you know, let's be clear about it. It wouldn't change my quality of life. I'd just carry on. It changed me mentally a bit, you know, down for the short term, and I'd be feeling absolutely gutted. But no stock will ever make or break me, okay? And
yes,
exactly. I mean, we'll just wait and see. The answer to the question is, I'm not being evasive. Is that it depends in terms of the company, and, you know, what my other stocks are doing, and how I feel, and whether I need the cash and all that kind of stuff. So I don't have a hard and fast rule. I think if it got above 50%, I would start feeling a bit nervous, to say the least. But anyway, I mean, you know, it's a big, I know if it went to zero, it'd be very, 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 very painful. But equally, it wouldn't kill me. It only, mentally wise, it would just be a major issue. But it's probably, as I say, it's got the best runway ahead. It's growing as fast as it can. So I just think I'd be crazy to sell at these current levels, because it's a really, really high quality business that is winning market share, and it's got lots and lots of different levers to pull to carry that forward. It could get taken out at any time as well.
Yeah.
So anyway, it's good. I understand I understand you've got a purchase as well. eEnergy just recently.
Yeah, well, do you know what? eEnergy, they listed quite a few years back, actually. When they first come on, Harvey Sinclair, I like the idea. It's eEnergy, or eLight as a service. Essentially, they'd refit all schools, pretty much, public sectors, no upfront cost, and it's as a service model, and the smart LEDs, and they attach them to meters and all that stuff, and it reduces your carbon footprint. So, I mean, and I quite liked it. I got in, and then they started acquiring other companies. Oh, hang on, I mean, the acquiring cycle, you know, spooked me a little bit. I thought it got out. But now they've got 4 different companies now, through from the smart metering to procurement, EV and solar charging now, and they are complete, integrated end to end, and they can reduce companies, sort of carbon footprint and their energy bills. They got long-term recurring contracts. Well, the market cap is 28 million. They're going to be doing 23 million this year. In fact, the year's just ended on the 30th of June. There, 3 million EBITDA. Forward order book is growing like from 18 million at the end of December to 23 million March. Record orders in Q3 of 8.6 million. Momentum as they continue to Q4. They just launched solar pretty much. And
what's their USPs though?
Well, they are fully integrated. I've compared them to SMS. So I looked at SMS, but essentially, like I said, they started with E-Light, okay? And now they can, of course, 30% of energy used by companies is wasted. So to find that waste, first of all, you have to hook it up with, they've got an award-winning proprietary smart tech sort of metering system and analytics-based system there. They can identify that straight away. But essentially, they'll come to you and they can reduce your bill pretty much. And they've done it recently with school trusts. This one company has seen the energy bills go up from £1 million a year to 2 million. They brought it back to 1 million, and there's no upfront cost for the company. So they'll bring you down on net zero, close to reduce your carbon footprint, reduce your energy bill. There's no upfront costs. There's no cash flow expended by the company. And so they're fully integrated across, reverse auction platform to procurement, to smart metering. Then they actually generate energy for you by putting solar panels on your roof. And that right now, solar energy is about 50% cheaper than the grid, get off the grid. And also they can install EV chargers as well. This is no upfront cost to the client whatsoever. So they've got this integration. Do they resell power at all? Yes, they do. So they've got an investment fund in Switzerland. They've got 20 million euros from an investment fund that sell receivables spread off. So the upfront costs don't sit on eEnergy's balance sheet. And they sell forward like that. So they don't, obviously they're not the energy suppliers. They're in no way connected with these energy companies going through. Their platform, which you can get access to free of charge, is reverse auction connected to all the big energy suppliers. So at a click of a button, people can see where they can switch straight away. So where does the energy supply contract lie then? Does it, let's just say I'm the local authority and I want the power. Who do I contract with in terms of that power supply? Well, you go through their procurement platform, for example. You find out the lowest cost producer, and you go through there. So, but essentially, eEnergy gets its revenue from 2 sources. They're a consultancy as well, so they'll help you consult. They'll bring in so that will be paid by the local authority. Yes, so that will. But also they get supplier fees, So that's based on a percentage of the volume, not on value. So right now, obviously, companies are trying to reduce. So where's the contract though? Is the contract? The contract is between, for the consultancy, it's between the actual company. No, the power. Well, the power would be, I'm assuming, through the supplier. But yeah, okay. So they don't have they don't own the customer on the power supply. They just get a commission, do they? They get commission. Yeah, typically 1 to 3% around about on the volume used by that customer. Okay. Okay. But like I said, what I like about it is literally, I was thinking recently, I thought, right, we are going to a slow growth economy pretty much. There's a lot of worry around. You need, now, their contracts literally last about 6 years, and that's the average contract, and they're recurring. And I thought, what you need is, in an unpredictable economy, you need, sort of predictable sort of inflows. In a hot area right now, you can imagine like that school trust. There's great videos on the website of testimonials saying they brought the power down hugely for us. And I said that one education trust doubled. Their energy bill has doubled in the last few months, and they brought it back to where it was, and yet they get 1/3 of the savings as well. So any savings they make pay for the consultancy and the fees up front. So it's almost like Harvey's been. I saw him at this conference online, this net zero conference. And he said, when we come into companies and we propose them, and most of them think this is too good to be true. We don't have to spend anything. You can reduce the bill, and the savings we make gets paid to you anyway. So I don't understand what's the catch. And there's no catch. Honestly, we're backed up by a fund, so we don't take any risk ourselves. So I really like it. Like I said, the growth. I mean, if you look at the growth as well. How much money did you put in there? What sort of percentage of your portfolio? At the moment, I'm under about. Under 15 15% of my thing, but I've been scaling in, just taking from top.
Sorry, it's under 15%.
Yeah, under 15. Yeah.
That's quite high, isn't it?
Well, not really, because well, I suppose so, isn't it?
What's your biggest position percentage?
XPF is a bit above 15%. That's taken a hit recently.
Okay, so it's about 15%. So 15% is XPF, but this one's just under 15%.
Yeah.
No, I mean,
so,
okay, but I mean, is it less than 10%? Is it between 10 and 15%?
No, it's between 10 and 15. Yeah, at the moment.
Okay, so it's quite a good sized position, isn't it?
Oh yeah. I've been watching this company for years, and literally they're probably going to do one more acquisition, and that's in the solar area. But if you look at revenue growth, I mean, they're consistently hitting, organic growth way above 20%. But 2020 they did 4.5 million. 2021 13.6 million. So over 200% growth.
So what did you sell then? I
just top sliced everything. Let me finish this a second. Oh, listen to me. So 2022 23 million. That's 70% growth. 2023 they got 30 million, and EBITDA is going from just in 2021 800,000 and 3 million this year, 5 million next year. And this is without, I mean, the fastest growing area right now is generation for companies. Literally, they can put, solar panels and EV chargers in schools, whatever, and it won't cost the company anything. Getting energy from the grid 50% cheaper. And so I think it's a very high growth area. First of all, high energy costs is a big problem for all companies, and getting net zero as well, a longer term trend, So hot recurring revenues, long-term contracts, and they're profitable this year as well.
Okay, cool.
Yeah.
Another one, that whole energy, Getech. I understand they won some contracts as well.
Yes, well, this is on their. It's nice to see that they're winning contracts on the traditional part of the business, where they license out software and stuff, of course, for geospatial, for critical metals companies, petrochemical companies, all oil and gas companies like this. It's nice to see that they're saying they're going to do double-digit revenue growth on that side alone this year. Taking another hit as well, though, but the real exciting bit is the green hydrogen, play, and that's going to take a while to kick in. And in a bull market, you'd see companies like this rally on hope high potential, but in the bear market, that doesn't happen. So they are down to like 13 million. I mean, 2 times sales on that. But yeah.
And how much did you put into this one percentage portion? Is this another 15%? Is it 10, 15?
Around about originally 10%. It's dropped again though, so it's so around about 10%.
And just on that hydrogen side, how much do they invest up front?
Well,
in each hydrogen hub?
Well, they don't. They brought us in a consultancy, and they do all the the project management, all that kind of work, and use their software stuff. So they're given pretty much it's around about 20% equity stake in the project project level. So then
they get paid sweat money for a percentage into the project, right?
Yes. Okay. So SGN, for example, Gasworks Network will pay them to help out sort out the best locations, all that stuff.
And what's their USP? Because obviously they look at all the seismic data on the oil and gas side of it, and they help with.
Well, I would say, I mean, obviously exposure to green hydrogen is a thing, but they have a very much low risk. There's no capital upfront cost for them to get.
No. What's their USP? If I'm somebody who's wants to set up a hydrogen hub, why do I go to Getech to help me do that?
Well, I suppose their software. I mean, that's why companies have employed their services, because their software and their locational, geospatial, all that thermal software that can locate best places that locate stuff. So I assume that's a selling point, So
because that's all historically been subterranean, hasn't it? So it's basically it's finding it's seismic data, which is like hundreds of meters underneath the ground for oil fields and gas fields.
Yeah, no, I think there's 4 parts to their software package, and I think obviously there's attributes from those that the reason why SGN have signed up with them all, and people like this, and obviously the Inverness and Shore and Port have signed up with them as well. So I assume they see their software in it. But at the moment, it's not my biggest play, because they've got plenty of cash. I mean, they've got like I think 5.8 million of cash. They're not burning a lot, and I think last time I looked, they got 88 months worth of runway for their cash. So based on the last cash burn, the final statement. So plenty of cash there, and I'm just thinking it's one of the things to sit on and wait, because green hydrogen is not going away. The trend is building. In fact, I think now, even today, Shell has announced one of the biggest investments into a green hydrogen hub in Europe. So the money inflow is huge into green hydrogen. You know, there's a lot of people still saying it's not practical, but you know, we know things change with inward investment. You know, costs come down. So I think it will play a lot bigger part in the energy transition going forward. But it's one of those things where I think, you know, it's good to have a little bit of exposure to it, because it could be, you know, a game changer, you know, over time.
Yeah,
So,
no, absolutely. I mean, let's be clear about it. There are plenty of opportunities out there which have come down and they look undervalued on a bear market. I mean, I had another one which I've mentioned before. You know, I've invested in activeops, which basically does it does, you know, software that helps banks manage their employees much better, sort of like on a hybrid basis, remote working. And you know, sort of like things like know your customer, sort of complex tasks and this sort of stuff. And it's sold them into lots of, you know, sort of as I say, in insurance companies and banks in the US and in the UK, and also out in Australia. They're growing at around about sort of 10% ARR per annum, and that may well accelerate this potential year. High margins, unit economics, sort of 80% gross margins. They've got plenty of cash, and they're trading on just less than 2 times sales. So it's a high quality business that's got a long sort of growth trajectory, all in software, SaaS software. You know, they sell their software around the world, but, you know, across in, say, North America, Asia, across Europe, and also in the UK as well. So they're doing well, but the shares have come off a lot. They're roughly around about 70p at the moment, and we'll wait and see on, you know, on that one. But I still think they're a good quality business that potentially could be, you know, sort of bought out. But anyway, they came out with prelims and then reiterated they had a good start to the year, in line with expectations, and I think they're going to carry on growing strongly as well. It's not one of my biggest positions. I haven't had much sort of cash available, but it's one to watch. Another one I own, which you know, which it's actually been through the mill quite a lot, is Rosslyn. I've talked about it quite a lot, and that's got a lot of different moving parts and levers. It's got sort of 3 parts of the business. It's sort of core. The Rosslyn software helps companies reduce their supply chain costs and procurement costs, which has had a huge technology refresh over the last year. And then it's seen orders defer to the right and being pushed out up until that sort of like project refresh. And so with the new software platform, we should start seeing a lot more growth, and they're starting seeing that in the inquiries. The big thing is if they're going to convert them, being a fairly small cap company. So that's their core business. And then they've got 2 others, which is unstructured data, which they bought, which used to be called Integrity. And then also this custom software that helps businesses import from Europe and the rest of the world, which is the old Langdon business. And I think both of those are currently, you know, in the throes of being disposed of, and they should get some decent cash. So it's a lot of moving parts and levers. The shares are trading at ridiculous levels, sort of 1.8p now, which means the market cap is 6p. They've got, even at the end of this year, I mean, they're investing in their platform. You know, even at the end of this year, they should have sort of like, you know, £2 to £3 million of cash. That's half of it in cash. And then, as I say, the software platform just on itself should be worth at least sort of like, you know, 1 or 2 times sales. So I could easily see this all bundling in sort of 5p from current levels, but it's a lot of moving parts and it's difficult to see. And, you know, well, let's wait until the disposals happen, how much money they can realize, and then really the nuts of it is going to be whether they can convert a lot of interest. They already started of doing that with a couple of financial institution contracts. It's early days. They've only just relaunched this product refresh, so we'll wait and see. It's been a disappointment on, you know, so far as a shareholder. You just got to live with it, really, and just see how it goes.
Are your thoughts on that? I mean, you said they're getting a lot of inquiries. Do they seem positive? Do they seem like they're going to get some growth from that, do you think?
Well, they do seem it, yeah, but they've been seeming it for some time. I mean, logically, one would say is that ahead of a major product software refresh, you're going to see orders which are going to be basically held off, because if you're a customer, why'd you buy the old software and then have to implement the new software? You don't do it, do you? You basically wait until the new one they've only just, in the last month, they've only just launched this new solution. They've had a lot of beta testing. Lots of customers have been really happy with it. They've already signed up 2 sales, major financial institutions. And it comes down to, you know, landing and expanding on the existing customer base, upselling those. It's going to be a SaaS recurring model, and then selling it on through partners into new, you know, applications. It drives a significant amount of. They're in the right space, but they've been in the right space for a long time, and it's going to come down to execution. And I mean, I've spoken to the CEO, who I've been pretty impressed with, but the chairman. I mean, they seem to be a good quality management team. As I say, it all comes down to execution now. Exactly.
So where now, if looking back, would you think I should have sold those, or are you still happy to hold? Or I mean, at what point would you think, oh, this is not going to plan? What would you, you know?
In hindsight, well, I mean, you know, I mean, you can't. It's always the same, isn't it? When it comes down to hindsight, you just got to expect that when you invest into stocks, and I've said this so many times, yeah, 1/3 of mine I'm going to lose money on, and 2/3 I'm going to make money on. Yeah, that's just the way the maths works on the small cap space for those type of companies. I do. At the moment, it's gone down, but that doesn't mean I don't make money on it. You know, this could easily turn quite quickly, and I still think it has. If I was going to, you know, sort of look at where the current shares, I still think there's significant more upside than downside. At current levels, you know, they're sort of like a minute part of my portfolio. I mean, they're 1% of my portfolio value now, having been about 5%.
Yeah, but you know what I love about investing though is a different strategy, because I remember listening to one of the Motley Fool guys, and literally he doesn't ever sell. He said literally, I'll buy a company that I think is very good.
I do sell. I do sell.
No, but do you know his thoughts are, and that's it. He said, I don't go crazy big on any stock, but if a company is a consistent winner, it'll become a bigger part of my portfolio, and that'll do multiples of you know, of the initial investment. Now, if I invest in a company that's dying, it'll become less significant in my portfolio. It may die in wither, but it may recover. I don't know. So you know, it's an investment thesis is still the original thing. There may be more delays, but and I see this logic there. But there are other people who are more trader-like who just get out at a 20% loss or something. But I understand both concepts, you know. But
I mean. No, I always go into an investment with a sort of 3 to 5 year time horizon, and I like to see the actual investment thesis play out, good or bad to a certain extent, and I'm prepared to take some of the pain. And remember, the key thing of all investing, in my view, okay, is you don't use leverage. You don't borrow money to invest in small caps, because if you do, you get distressed selling. Least we have time.
Let me say that's a good point. That's distress selling. So bringing on to that, a company that's growing very quickly, but it's taking a big knock. My biggest hold in my portfolio is XPF Factory. Now they came up with an AGM trading statement. Fine, everything's going to plan. The 27 sites they plan at the end of the year is going according to plan. Okay, there's a delay on Oxford Street, 4 or 5 months, because they said there's a more rigorous planning application going into there, because of course the state is on. But you know, everything pretty much, and we're going from like 7 million in revenue this year, last year, sorry, to 25 this year. You know, 3 million EBITDA. Next year's gonna be 40 million with 6 million EBITDA, and yet a big. I'm not going to say who this is, but I suspect I know who it is who is selling, because another stock he owns that he told me he also sold, dumped about £1 million worth of stock in one day. And I think, my word. And so it literally dropped off a cliff. And I was even chatting to the CEO, what's going on? I don't know. I said, in a bull market, that AGM statement would have pushed the share price up. But for some reason, I don't know why this person is selling. It may be on leverage. It may be distress selling elsewhere. You know, some kind of contagion from other stocks he holds. But it's so annoying when this happens. But I mean, right now it's you know, it's cheap. And when, you know, what are we? We're literally, I think they have about, you know, I think 6 million of cash. They're at 22 million market cap. And so they're trading less than 1 time this year's sales, and they're going to be profitable, which is like.
Well, I'll give you some good news anyway. Okay. It's definitely got on the radar of some pretty professional investors. I mean, I don't know if you've noticed, but Paul Scott from Stockopedia, who's an absolute retail genius and anything all consumer and bar it's now right on his crosshairs.
Yeah.
He just thinks it looks a really low valuation, and competitive socializing is a concept that is working, and Boom Battle Bars seems to be a good place to be. So when you get those, the downside is that you have to suffer some pain in the short term while somebody dumps their stock. The short term is that actually it starts that to people who have got some money and the people who have got influence and the people who understand the whole concept, it starts to become ridiculously undervalued, and it will recover at some point in time. I mean, that hasn't happened for me for Boohoo, that's for sure. Because
no, but you know, it's painful. I just read one thing, because the brokers update the note there, and I mean, if they roll at these targets, these sites, as they say, they're going to be doing. Just looking at the figures here, 52 million of revenue in 2024 with 10 million of EBITDA. And right now they're literally trading. Like I said, they are 23 million market cap, 6 million of cash, and they're going to do 25 million in revenue this year. It's crazy. I mean, that really annoyed me when I started dumping. The volume was going through. Who the hell is dumping? And but you can't do anything about that. Small caps, that's going to happen.
Well, you can live through it. You're like me. You don't use leverage, so you don't become a distressed seller.
But no, it's bloody annoyed me though. It wasn't, a cracking company.
There's lots of things which annoy me, but frankly, you just got to live with it on the markets.
Yeah, Boohoo, go on, mention Boohoo. What happened there?
No. Well, I mean, anyway, that's less than 1% now. I mean, I've lost quite a lot of money on it, as you know. But anyway, I wasn't going to give you an update on Boohoo because I did that last time. Okay. I mean, better news, Avacta. Okay, now, I mean, this is another classic. Just on the sort of the COVID testing, it got sold off to around about sort of 50p, 60p. It's an idea, and then it's sort of real value drivers, which is the prodrug it does, the prodoxorubicin, is continuing to go through its phase 3 clinical trials in the UK, and it had more very good safety data that they're escalating the dosage now in their third cohort to roughly around about 2.5 times the sort of like the concentration that existing doxorubicin without the prodrug overlay on. This is their precision platform, so it's significantly safer in the body than existing chemotherapy, etc., and isn't causing side effects. And that's also really good because the people who are in this clinical trial are very, very sick people. And on that basis, if it isn't actually damaging their, health and their safety, then that's a really good statement. Anyway, the phase 1 is split into two elements. The first phase, which should be finishing over the next few months, is to escalate the dosage to a certain level to be able to recommend the maximum dosage level and dosing regime to then take it to the second stage of the phase 1, which will start afterwards and last for another sort of 12 months, which is then to see continue seeing the safety data and also the efficacy at that agreed maximum dosing level and dosing regime. So it's really doing excellently, and the shares, not surprisingly, have recovered because this is like a $60-70 billion a year type of industry, sort of chemotherapy. If prodoxorubicin can be shown to be effective and safe with what it's doing, because you'll get then a whole series of different chemotherapies that can be utilized that currently haven't been able to be used and deployed in patients simply because they're too, sort of like toxic, particularly around the heart, etc. So that's really good news. And then the other side, which is they've got two major big platforms. They've got the precision platform and then also the Affimer platform, which one of their lead partners, their licenses, LG Chem out in South Korea, said is making good progress in preclinical trials for one of its immunotherapies they're developing, and now it's going to go into clinical trials. So that's a great sort of endorsement, and they get a royalty off the bat. Effectively, they get a payment up front of $2 million, and which shows the efficacy of the Affimers working in terms of that helps the. But if you're Affimers essentially are like antibodies they help a drug's efficacy in identifying and attaching to biomarkers, whether that be in the body or, or on a foreign part of the body, not say on a cancer. But then the other part of it is they're utilizing it to influence the time duration that a drug can stay in and be effective within the actual blood, which is really, really important, because let's say, for instance, if it's safe for a long period, then you don't need, as a hospital, you don't need to have your patient in to inject them with the or intravenously inject them with the actual drug as well. So it gives huge sort of efficacy benefits. Anyway, both of those are doing really well, and there's lots of other different shots on goal that the actual business is doing. So they've gone from strength to strength.
So how would you? How do you vary that then? Because I have no idea.
Value it.
Yeah. What are they at now? 250 market.
Well, you have to basically value it on a risk-adjusted basis to see how much each potential opportunity has got. What its peak sales could be. You value that as on a cash flow basis, and then put a risk percentage on it in each potential sort of drug line. To reach a total value for the group. So it's a risk-adjusted cash flow DCF analysis for each real sort of like drug compound, etc. And I haven't done that, but one of their research houses, Delta Trinity, have done it. I think it was £2.19 when they did a risk-adjusted valuation of each of their particular drug lines. There's plenty of upside. I mean, who knows what it would be? I mean, if let's just say, for instance, I think they've only got, the Trinity Delta have only got a very low probability that this prodrug, the prodoxorubicin, is actually going to come to market. But if it happens, then that will obviously go from that low probability to a high probability and significantly improve, the valuation of the business. So this huge upside associate, potential upside for this actual business if they can bring that, that to market. Time will tell, but it started off really well in phase 1 clinical trials.
It's amazing when you see, markets, they always overshoot, don't they? They always go from, overbought to oversold. If you look at that share price, it went down to like 40 pence, then zoomed up to 140. Now it's settled halfway in between, which, for now, it's probably a good support level there, about 97 pence. So, hopefully it goes.
I mean, it was just, but I think people were just lost it, hadn't they? They were just basically selling irrationally. They were not looking at sort of like, the actual underlyings. I mean, just coming more closer to home, Lord's Group Trading had an AGM update a couple of weeks back, and they said they were all in line with expectations, in line with what they actually on track with what the brokers are doing, and that their profits are well underpinned by the resilience of the repair, maintenance and home improvement markets. That's 80% of their turnover. Yes, they've still got supply chain issues in terms of getting boilers from their suppliers, because they can't get, this is a classic sort of China issue, they can't get the pumps from China to be in sufficient quantities to be able to complete the manufacture of the boilers, to then sell the boilers to the likes of Lord's Group Trading, who can then put them into people's homes. So that's one small point, but that's a small element of it in terms of profit terms. The bigger element is the repair maintenance, and all the house builders are currently saying that's still strong. The house prices are still strong. I mean, it can be a lagging indicator, but I still think for this year, regardless of what happens, whether we're going to get a mild recession, a tough recession, I still think the housing market and the repair maintenance is going to be strong, because you just got to look at what everybody's saying in the actual industry, the distributors.
Yeah, Persimmon were very bullish, actually. I mean, if you see their report, they're quite bullish. They're still saying strong forward order book.
Look at what Vistry said today. I mean, Vistry was saying this is accepted. Really, they've upgraded their numbers. So, I mean, who knows? It depends on if we get a resolution to Ukraine and Russia, then clearly, this is going to be a massive sentiment shift.
I think they'll be surprised as well, because most people almost, it's gone down the news agenda, isn't it, with other things happening, and people are thinking, they've given up on that pretty much. And if out of the blue, Putin decides Donbass area is his victory, and he says, that's enough now, and he moves on, and the markets have a huge boost.
Well, I've done a conservative valuation, and I get to £1.29, and the shares are currently 72, and this is a real sort of like rock solid, steady Eddie, type of business that's been around for years and pays a dividend. So you can go a lot, it's like Avingtrans. You know, you've got great management team, knows what they're doing. They just do what they do really, really well. They're growing twice as fast as the industry, and they've done that consistently for years. So it's a classic winner in a sector that has still got secular growth trends. We still have far short supply of housing and quality homes in the UK, you know, because the housing stock, there's at least a third that needs serious repairs, and these guys are the kinds of people who do it. So, you know, they're all systems go.
I mean, hang on.
Yeah, and then I had a couple of updates on Belluscura, you know, this basically best-in-class portable oxygen concentrator firm that's commercializing those medical devices out in the States. Well, it had two good pieces of news about 2 weeks ago. Firstly, that it's upgraded, just launched its new upgraded version of its flagship portable oxygen concentrator Explore, and that's now incorporating Bluetooth data gathering functionality that allows you to include things like stuff from your pulse emitter, and also from you know, sort of wearables like watches and stuff like that, and that aggregates all the data into a depository and helps you improve the efficacy and the treatment of those individual patients, which is actually an industry leading first. And that data will be, you know, very valuable going forward. So that was good. And then they've also announced the launch of their direct to consumer model. As I mentioned before, the biggest industry player here, Inogen, has really been struggling in terms of supply, and they've been pushing up their prices. And this one by doing a direct to consumer model, it allows users and patients in the US to buy top quality technology at affordable prices direct from the actual developer, which is Belluscura. So this one should actually really help the sales. It hasn't been reflected yet in Dowgate's, the house brokers numbers, but they come at a valuation at about £2 per share. I've got round about, I think it's 180 to 240 as a valuation range. And I think the shares again, you know, has just been artificially sold off. Now they're 80p, aren't they? So, you know, you look at it, plenty of upside.
I saw a good quote yesterday, actually. It reminds me of the extremes of the market, essentially. When the market is really bullish, no one really pays attention to valuations too much, so it's buying.
Yeah,
when the market is really bearish, people ignore valuations again and just sell. So it's like, it's somewhere in between is where people are sensible. But yeah, we're now, you know, it's 36% down on AIM. You know, it's a lot of it's priced in, isn't it? You know.
Yeah. And then the final one, which is worth mentioning, again, it's been one, you know, and I would stick my neck out on this one. It's down roughly just over 50% from its all-time high. Box, which is a real quality franchise of, you know, it's basically the UK's go-to provider of sort of luxury yet affordable fresh cream cakes, you know, in the stores. And just as an example, I mean, I used it for the first time last year for my dad's 80th, and all the guests absolutely loved it. I mean, and genuinely, my stepmom is just like, you know, Sook's best friend, because she was gobbling the spare pieces because, you know, they couldn't, it was like a really big cake. And so she took some home and she was having it for the next week. But anyway, it went down so well that my daughter, who's having a sort of like a do at the end of August, wants it as well. So we're going to get it there. And I was interviewing Sook in terms of his new products, and he's putting out a lemon flavored cake fairly soon. And my wife just thought, wow, brilliant. So you've got a lot of sort of like very good early sort of users like our family who are going to use it for years, because you can guarantee that you're going to get a really fresh, lovely cake at a reasonable price. And so you don't have to worry about going down M&S or a local supermarket and getting a dodgy sponge that could be good and could be not good, you know. So, you know, for anything where you have families, you want to impress them. So anyway, when it comes to the actual numbers, I mean, they had Blockbuster last year. They beat they met their expectations, but those have been revised up 2 or 3 times. Yes, they've seen a sort of slight softening in the first sort of like few months of this new financial year, but they've still got plenty of new franchisees who want to take on put on a new store. They've got lots of white spaces in places like Cornwall, Scotland and Wales, etc. So their growth trajectory could easily get to 250 stores from about 180, 190 currently. And I was on the call when I interviewed, they have also their marketing director, and he's got a target to get the business over the next sort of 3 years to the online side to roughly around about 50% of just direct and click and collect. And I think it's currently about sort of 20-25%, so significantly growth, lots of growth there. And then longer term, there's also opportunities overseas to sell off sort of franchises as well over there. So it's got plenty of cash, it's still doing really well, growth is good, and customers love the product, importantly. So that's a classic baby in the bathwater stock.
Yeah, but you know what? Myself and John Human do this stock screening, podcast every week where he comes up with screeners with criteria, looking for some quality sort of putting quality metrics in there. And Kate Box has come up about 3 times now.
Yeah, I'm not surprised.
I've got to stop talking about them because I noticed I wouldn't mention them again. I understand they're a very good stock, but I mentioned them so many times. But yeah, they are. It's just one of those things. Again, baby bath water being thrown out there, and it's looking silly. Like lots of companies.
Even better, Justin. Go and try the product. You'll love it.
I will. And do you know what I can understand is that people worry about the cost of living squeeze. People are always going to celebrate birthdays.
Yes.
It's not going to stop. And
you can get a lovely cake for like 20-25 quid. I mean,
yeah.
But the important bit is when you get your family around or some friends and some guests, you're less bothered if it's just you, and you can just say, okay, it's just me. But when the guys are expecting and you want to showcase a nice meal and have a bottle of wine and this sort of stuff, then the last thing you want to do is for them to have a dodgy cake, and so the quality is 100%. So anyway.
Yeah. And you know what? I like that the cost of living squeeze. Part of me, with things that was in XPF as well. A lot of the things that go on with XPF, for example, people going out, they are birthdays, they are events, there are work dues. That's not going to stop happening. Even if that continues, it'll be fine. So it's not worrying. People are always going to celebrate special events, and like I said, and it's cost of living squeeze. It's going to be around. It's basically the markets have priced this in pretty much. Cool. Anything else, Paul?
No, I think we're there. I mean, as I say, the last bit for sort of investors is keep your head up. Don't worry. Don't become a distressed seller. Live through it. Everybody's going through pain, and it's a matter of this is what the market does occasionally, and that's all part of the learning curve.
Yeah, and just looking at Russell 2000, small cap in America index, the chart is very bullish. I don't think we've, it's the bottom. I think we may have to go up and come back down a little again, but it's very, it's, like I said, bottoming process takes a while, doesn't it? But I mean, I think we're seeing some bullish sort of movements. It's closed at the session high, the last few sessions, and higher highs, higher lows, and it's quite bullish looking at the chart there. So we may have seen, maybe we've seen a bottom. I don't know. We may have to retest, but it's not all down at the moment. Some are going up, so it's looking a bit more bullish, I think. We're close to the bottom anyway. Marvelous stuff.
Cheers. See you in 2 weeks' time.